Alright, what if you had $100 right now? You could buy virtually anything with it, from a gift, video game, to a service like a Netflix subscription. Well, the idea of this video will be to transform this $100 bill into $101, $102, or even $200. In other words, into an asset. Welcome to investing. Hi, Jarod here, and today let's talk about investing. So, before diving in the stock itself, what is the stock market again? Let's break it down, starting with the basics. And to make things simple, the stock market is a place where we buy and sell shares of a company with the help of money, like the euro or the dollar. The more people invest in that company, so the more they put their money in, and the higher the price will be, and the higher the market cap also, so the total value of all shares. Then stocks, also known as equities, represent an ownership of a company. So when you buy stocks in a company, it means you own a part of that company. So the more shares you buy, the more stock you have in a company. Stocks are issued by companies to raise money to grow their business. Usually owning at least one share gives you the right to vote and participate in the growing earnings of that company. Then why invest in the stock market? The most obvious reason to consider investing in the stock market is to help grow your own money over time. You're also supporting other companies to grow and supporting the economy as a whole. Of course, there are risks linked with investing in the stock market, which we'll talk about later. And finally, how does the stock market really work? Why does the market go up, or sometimes goes down, or does nothing? In fact, it is highly simple. They can buy Apple because they think it's a great company, because they like their products and services, or because they just think the price will go up. And they can sell because they think Apple is no longer a profitable company, or they might need their invested money to buy a new house, renovate their own garden, or whatever. In fact, the market is irrational. People buy and sell based on emotional decisions. I used to think that the price of the company equaled its intrinsic value, so what it's truly worth. I was wrong. In fact, sometimes the company can be overvalued or undervalued. Let me explain with this graph that radically changed the way I see investing forever. The price of a company doesn't reflect its real value. Here's the price of Microsoft over the past 5 years. As you can see, it went from $84 a stock to $240 a stock today. And here are Microsoft's earnings over the past 5 years. As you can see, it's still going up. Its earnings increased by roughly 35% a year on average. And despite that earnings, Microsoft went down in 2022, losing roughly 30% of its value. Alright, now you know how the stock market works. So what would be the easy way to invest in it? Well, first thing first, investing is risky, no matter what you invest in. And you must be wondering how much of your wealth or income you should invest in the stock market. Maybe you know some rules, like 40% of your income, then the rest into savings or bonds. Right, well, my approach is much more simple. I invest the amount I am willing and comfortable losing. No complicated math or ratios are needed. I simply invest what I am ready to throw away. And the question is, how much would you like to have in return? And let me introduce you to the S&P 500. This weird name, which seems to come from an action movie, is a basket of the 500 biggest US companies. So, instead of investing in individual companies, you can buy this group of companies as one stock. It's as simple as one click. For now, it counts Apple, Microsoft, Tesla, Amazon, Coca-Cola, Nvidia, McDonald's, and so on. So if you own this basket, you basically own the world. And if for any reason one company goes down enough, it will be automatically removed from the list as other companies will replace it. And the good news is that it historically returned around 10% a year on average for the past 80 years since its creation. As a reminder, inflation should be at around 2% a year on average, and this 10% still beat inflation by 8 points. Moreover, you should add another investing technique to maximize your return over the long term. I am talking about dollar cost averaging. Dollar cost averaging means investing a small amount regularly or each month instead of investing everything at once. And this helps smooth out your investments and minimize your losses. So let's say you continuously invested $100 a month for the next 40 years, which seems realistic in my opinion. You would have 230k in the end. I know, it seems unreal, but this is the power of the compound effect. It starts small, right? But once it kicks in, you will see significant growth over a long period of time. Alright, the minimum you can safely make in the stock market is at around 10% a year on average. So, two things. First, if someone proposes you to invest your money to make 8% or even 9% a year, just refuse. Simply because even with 9% a year on average, you will only make $185,000 after 30 years, so 25% less with only 1% less. And what if you could make even more, with still a safe strategy followed by Warren Buffett itself? Let me introduce you to my own approach to investing. So, what is my approach to investing? Pretty straightforward. I want to have more in the long term, let's say 5 to 10 years at least. And I simply take companies that I know, like, or simply heard of somewhere. Could be anything. I build a watch list, you could take a pen and a piece of paper for that, but I prefer to use Google Finance. Then, I make some research on Google about two things. First, I want the company to have competitive advantages over its competitors, and I want the company to be well managed. For instance, Coca-Cola has a competitive advantage with its secret recipe, and it also has strong brand recognition for the past 130 years. Or Apple with its reliable iPhone. Thirdly, I look at the company's financial statements, and I know it seems like a hard task to do, but no worries, you just have to read some lines on Google. First of all, I look at the company's dividends. If it does not pay dividends, I simply ignore the company. A dividend payout is most of the time a sign of a healthy company, and it's also a security if stocks are down. We will see that later. You have to check for how long the company has been paying dividends, if it cut them or not, and what's the dividend yields. Not too much if possible, and not too low. Between 1 and 4 is the best, in my opinion. Then I look at the company's net income. So it represents the earnings once all expenses, interest and taxes have been subtracted from revenue. I also look at the earnings per shares, so the net income divided by the number of shares outstanding. So if the company earned $1 million this year and has 500,000 shares, then 1 million divided by 500k equals 2. And it means that as an investor, you would have $2 for each share you buy, and the more, the better. Then, I also look at the debt to equity, the P/E ratio, and return on capital. And please, remember one thing, I always look at the numbers for at least the 5 last year, maybe 10. When it comes to dividends, I look at the whole history of the company. And let me introduce you to Graham's formula from Benjamin Graham and his book The Intelligent Investor, which I would highly recommend. And by the way, Graham was Warren Buffett's mentor, and what he teaches in the book and to Buffett is still highly relevant today, from the investing principles to the method he employed. There you have it. We want to know the expected value of a company in roughly the next 10 years. Let's write V for value. Then earnings per shares, which represents the last 12 months EPS for the company. We talked about it earlier. Then 8.5, which represents the P/E ratio based for a no-growth company. J is the reasonably expected 10 years growth rate of the earnings per shares. 4.4 is the average yield of AAA corporate bonds. And Y is the current yield on AAA corporate bonds. And a bond is basically like lending your money as an investor in anticipation to have more in the future. And AAA simply shows the security and safety of the bonds. And in fact, this is the highest. For example, the AAA corporate bond yield today is at 4.63%, which means that if you lend $100 right now, in the future you will get your $100 back plus $4.63. Alright, we now know how to choose, inspect and value a company. Let's now buy a stock, and I will do it in front of you live, so you can follow along and do the same. The company was founded 45 years ago in 1987. It is one of Taiwan's largest companies, with its headquarters and main operations located in Taiwan. It is the world's most valuable semiconductor company, which is also the world's largest dedicated semiconductor foundry. You may have got it, I am talking about TSMC. To make things simple, TSMC makes processor chips for brands including Apple, Qualcomm, AMD, Intel, Texas Instruments, and Nvidia. And by the way, you can also follow along by reading TSMC's financial reports for 2022 or 2021, by the way. And I will put the link in the description down below. Does it have a what competitive advantage or a moat? Yes, it has. Its products are used worldwide, in every product. Smartphones, computing, the Internet of Things, 5G, and automotive. TSMC also maintained its leading position in the world, holding 26% of market shares in the semiconductor industry. Then, does it have room to grow? Yes, it has. Again, smartphones will need 5G chips for customers in the coming years, as it boosts demand, and thus the supply of TSMC chips. Then high-performance computing. This simply relates to computers like PCs, tablets, game consoles, servers, and so on. TSMC is also present in the Internet of Things, so everything around smart wearables, smart speakers, snake health devices, and so on. Automotive can play a huge role in TSMC's growth. As it says, the entire automotive industry is moving in the direction towards greener, safer, and smarter. In short, smart EVs with powerful chips inside. Alright, let's analyze its balance sheet. I would say that over the past 5 years, TSMC had 3 significant stages. First, its price went sideways. I guess it was a random company, no one truly knew. Then it went significantly up, because of the pandemic, I guess, as everyone was buying and using laptops, computers, and so on, which increased the demand for chips. And finally, it went down, losing 45% of its value. The company has been paying dividends continuously for almost 20 years now, while always increasing its dividend payout each year, with a current dividend yield of 2.31%. Its net income increased by more than 13% a year on average for the past 5 years, with a good increase in return on capital of roughly 15%. Moreover, it has a good PE ratio of roughly 15, when the average of the US semiconductors industry is at around 20. So the company is trading at around 15 times its current earnings, which is pretty good. It also has a low price-to-book ratio of 0.98, when under 1 is considered very good. And here's how to calculate it. So this ratio is composed of the price and the book. And let's start with the book. The book is equals assets minus liabilities. So it's equals 3 trillion minus 1 trillion. So around $2 trillion. Also has roughly 25 billion shares outstanding. So $2 trillion divided by 25 billion shares outstanding, which is equals 83.3. And finally, the price divided by the book. So 82.98 divided by 83.3, which is equals 0.99, which is close to what we got on Google Finance. Okay, great company with great and increasing numbers on the income statements. Now we have to make sure that the company is undervalued. Alright, let's get back to Graham's calculator. Remember, value is equals earnings per shares times 8.5 plus 2G, or the growth estimates for the 10 next years, times 4.4 divided by the current AAA bonds. Alright, let's do it together and let's use the calculator for that, on the phone for instance, or whatever. So first, the earnings per shares, which we can find on Google Finance. So it is at around 23 times 8.5 plus 2G, so G around, again is at around 21.5 on Yahoo Finance, so you can find that information at the bottom on growth estimates for the next 5 years in the financial and analysis page. Let's close that, times 4.4 equal 5,000 divided by 4.63, which gives us $1,125. There you have it, everything you need to know about investing from A to Z. And as always, I will keep learning every single day about investing and more broadly about life. And if you have enjoyed this video, then you will like this one, where I break down Apple's business, or this one, where I invest in front of your life each month. Thanks so much for watching, feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.